Today, in this episode, we are going to continue the left-out topics of our previous video, everything about order blocks. If you didn't watch the previous part of this concept, please go watch it, link in the description. In this video, we are going to explain the 4 types of entry using order blocks. Rules and criteria for identifying high-quality order blocks. There are 4 primary types of entries that we can employ when executing trades using order blocks. The selection of a specific entry type depends on various market factors, such as market's movement, sessions, volatility, and other relevant factors. By considering these factors, we can choose the most suitable entry type for executing trades effectively. The first entry method involves using the wick to execute trades. In this type of entry, after identifying a valid order block, we place buy or sell order directly on the wick. In the case of a sell position, we will place a stop loss of spread size above the higher wick of the order block. This entry setup provides a wider stop loss margin, which can directly impact the reward to risk ratio by reducing it. However, using this type of entry increases the probability of your order being triggered, since price may simply touch the wick and then pushing to your expected direction. The second entry type is referred to as the body entry. In this approach, once a valid order block is identified, the entry is placed based on the body of the candle. For sell positions, the stop loss is set to a spread size above the higher wick of the order block. This entry method typically offers a higher reward to risk ratio compared to the previous entry type. Because the stop loss is tighter, this approach carries a slightly higher level of risk. There is a possibility that price may only touch the wick of the order block, and then move in the anticipated direction without triggering your buy or sell order. Let's move to the next entry type. The third type of entry involves placing the entry at the midpoint of the order block's zone once a valid order block is identified. In the case of a bearish scenario, the stop loss is positioned to a spread size above the highest point of the order block. This entry type offers a reward to risk ratio that is at least twice as large as the regular entry types mentioned. This is due to the refined entry point and the smaller size of the stop loss. The fourth entry type involves placing the entry based on the body of the candle once a valid order block is identified. In sell positions, the stop loss is set to touch the higher wick of the order block. This entry type is undoubtedly riskier, because the stop loss is positioned within the order block's zone. If the price intends to fully reverse the order block, it may trigger the stop loss. It's important to be aware of the increased risk associated with this entry type. There are 4 essential rules that we must follow in order to identify order blocks with a high probability of success. Rule number 1 states that a high-quality order block must leave a significant inefficiency behind. Inefficiency refers to an imbalance between buyers and sellers in the market, resulting in a disequilibrium that needs to be filled. This is often observed as a gap within the candles. To clarify, let's consider 2 scenarios. If a 3-candle sequence does not exhibit any gaps, it is considered an example of efficiency. On the other hand, if there's a gap present within the candles, it signifies an example of inefficiency. Rule number 2 emphasizes that a high-quality order block must lead to a break of structure or a change of character in the market. Break of structure and change of character are essential signals that indicate whether the market will continue in its initial direction or will experience a reversal. Rule number 3. Price must sweep a liquidity zone before reaching the order block. By requiring the price to sweep liquidity zone before reaching the order block, traders can increase the reliability and validity of the order block as a potential turning point or an area of interest. This rule ensures that there is efficient market participation and confirmation of the order block's significance before considering it for trading decisions. Liquidity is a zone on the chart where a large pool of money is resting, such as stop losses, buy or sell orders. When a trader gets stopped out of a position, the market absorbs the funds associated with that stop loss. The market continually seeks to absorb this liquidity to generate momentum. Essentially, liquidity serves as the lifeblood of the market, playing a vital role in its overall dynamics and functioning. It is often speculated that central banks or large financial institutions may manipulate the market, creating scenarios that deceive traders into believing they have a clear understanding of price action. It's crucial to understand that if price sweeps liquidity zone before reaching our identified order blocks, then we can consider that order block as a zone with a higher probability of success. The underlying theory is that the market relies on liquidity movement. If the price fails to sweep liquidity before reaching an order block, there's a greater chance that the price will utilize that zone as a source of liquidity to propel its momentum. It's essential to consider this aspect when identifying potential entry points in the market, as it can significantly impact our trading decisions and outcomes. Here in this example, we can see two bullish breakout structures to the upside, leading to the formation of two distinct bullish order blocks. After a minor reaction from the upper order block, the price experienced a downward push to sweep the liquidity accumulated below the order block and also the equal lows. The reason for price not reversing from the upper order block is the absence of a liquidity sweep pattern prior to reaching it. Consequently, the price utilized that zone as a source of liquidity.
Recommended broker is Longhorn FX. It's an ECN broker dedicated to delivering a superior trading experience to traders.
Propelling its momentum. On the contrary, the reversal from the extreme order block can be attributed to the liquidity being swept below the upper order block and equal lows. By sweeping liquidity, the price gathered momentum and acquired the necessary fuel to move upwards. Upon reaching the order block, the price promptly reversed and made a significant upward move to sweep the buy-side liquidity. Thus, the extreme order block presented a higher probability of success in terms of trading opportunities. Rule number 4. It must be unmitigated. Order blocks are considered as one-time use, meaning we focus on the trading opportunity when price first enters an order block. Once an order block has been mitigated, we do not consider it as an area of interest for future trading. Because once an order block has been mitigated, meaning the price has moved beyond its boundaries and the inefficiency has been resolved, it loses its significance as a trading area. Subsequent retest of the order block may not yield the same trading opportunities as the initial entry. That's it, traders. In these 2 episodes, we have fully covered the essential aspects of order blocks, including how to accurately identify them in the market and recognize high-quality ones. Additionally, we have explored different entry types that can be employed with order blocks. In future episodes, we will delve into advanced trading strategies. Stay tuned for more exciting insight. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos.